Are you working for a startup and cash is getting a bit tight for the next few months before you fundraise? Hi, my name's Alysha Randall. I am a fractional CFO and I also train new and aspiring finance directors in startups and scale-ups. And today I wanted to talk about cash flows and how you manage your cash flow forecast when it's going to get a bit tight. So I have about 3 clients at the moment whereby their cash is going to be very tight over the next 3 months. And they're in the middle of a fundraise process. And it's worthwhile me keeping a very close eye on it with the founder, particularly as cash is always a moving beast. There are assumptions in a budget that may or may not come to fruition. And instead of looking at a live model, we look at a detailed cash flow forecast. So I have 2 templates that I use regularly with my clients. One of them you may have seen and is part of your budget already, one may not be. So I am going to give you access to the templates that I use, and I'll leave the link for those below. But I will take you through what I do today. So this video today is very much a working video, so it's going to be very practical. So I'll take you through what I do. There are 2 templates that I am going to share with you, both below's link and also in this video today. That is the higher level monthly cash flow, and the second one is the much more detailed scenario based weekly cash flow. So I'll leave the timings down below as well, because the first one you may already do and have already seen. If not, watch the whole video. Otherwise, just jump ahead to the second section. So the first one is your monthly cash flow. I prefer to use an indirect method just because I can see what's going on a bit easier with timing. Lots of people prefer direct. It doesn't matter, but I prefer indirect. So this is an indirect method. As I said, you should already have this within your budget and forecast. I use this for that longer term cash flow view. So when I'm trying to decide what the cash runway is, this is what I would use for that when I'm looking out, say, 12, 24 months. So just to go through this quickly, I would always have a budget with a client and then have a working live forecast model or a rolling forecast. And I'll talk about this in another article, which I'll leave below. But essentially, the reason why I do that, it's not ideal if you work for a large corporate and you have shareholders that you have to report to. A rolling forecast doesn't work. You need to have a proper forecasting schedule and method, and stick to that. But when you're working for a startup, and things are changing constantly, you are pivoting, your cash flow assumptions can wildly change month on month, then a rolling forecast is essential. And I think not doing a rolling forecast, you are really missing the proper control of what's happening in your business. So this is basically the cash flow forecast that I would have within my rolling forecast. So you would have obviously your P&L and your balance sheet, and your KPIs would be feeding in particularly to your revenue model and your cost of sales. And then off the back of that, then I would have this. So as soon as month end is being completed and approved and distributed, then the actuals then get updated in the cash flow forecast, and we have a look at how this affects the future cash balances for the remainder of the year. Sometimes it's good to go to 2 years. Obviously, the further you go out, the less accurate it is, but it will give you an understanding of when cash is going to be tight, particularly if you're still loss-making and relying on equity and debt fundraising. And it should give you a timeline, and the founders a timeline of when they need to think about raising doing an equity fundraise, particularly nowadays because we're in 2024 when I'm recording this. Raising capital is a lot harder. It's a lot more time consuming. You may have a lead investor that drops out at the last minute. So you really do want to fundraise 6 or 12 months before you run out of cash, rather than doing a quick top up round a couple of months out like you were able to do a couple of years ago. So the way this is, as I said, indirect method, you have your profit coming in from your P&L, you deduct your depreciation and amortization and anything that is non-cash. You can deduct your investment income and just put it down here. So this is just moving it from here down below. Don't have to. And then it's looking at the timing movements within your balance sheet. This will all just feed directly from your balance sheet. So for example, if your trade receivables or trade debtors increased from December to January, it would be a negative in here, because the revenue that you raised in the P&L you haven't received in cash. So that would be a negative. And then the flip side, for example, with your liabilities. So if your trade payables or trade creditors dropped month on month, that means you paid out more than is in your P&L. So you would have that as a negative. But if it increased, it would be a positive. So that's how you link that in. So assets is one way and your liabilities is the other way. Then you take into consideration the other elements that is not in your, potentially may not be in your P&L, or you're just splitting those out. So the increase and decrease in your sales tax liabilities. So again, in the UK, VAT is paid quarterly. So you will have a cash positive for 2 months because you haven't paid any VAT. The liability has gone into your balance sheet. And then you'll have a larger negative because you've had to pay the VAT bill in that month. And then dividends, I mean, this doesn't really happen in startups or scale-ups, but I put it there just in case. So that would be your operating activities. Then you have investing activities. I would say with startups, most of the time it is just purchases of CapEx. So, if you're buying laptops or what have you, obviously that doesn't go through the P&L. Or if you capitalize any of your tech spend. I generally don't do that. A couple of my clients do. That's fine. But if I was starting from scratch, I wouldn't. But that's where that would go, because it doesn't go through the P&L. If you're selling any equipment, great. And then any M&A would go in here as well, which is once off. And then finally, it would be the financing activities. So this is your equity or debt fundraising. So either you have done a fundraise and you've received cash for that, or you have received cash from a debt fundraise, and then or you have to pay your debt back. So the interest is up the top, but the principal repayment is here. And so then you have your totals. So they'll either be positive or negative depending on the cash movement. Then we have your opening cash position, the sum of all of the above, and your closing cash position. And this closing cash position should be exactly the same as your balance sheet. If it's not, stop reconciling and you need to go back and ensure that all movements on your balance sheet are captured here, and the P&L is also captured. Obviously, if you're doing this in Excel, it's sometimes, you download a P&L and then someone puts through a journal. So make sure that you lock your financial periods in your general ledger before doing this exercise. Otherwise, you'll be pulling your hair out. But if you can do this in a reporting tool like Fathom, that's great. And then you just kind of put that in here, and then you have your forecast. So I would always look at this on a monthly basis. So once I've put in my monthly figures, I would see how that's going to affect my cash runway going forward. If it's going to be significant, plus or minus, I would certainly have that conversation with the founder, particularly if it's going into the negative. So that is the monthly cash flow statement, longer term planning. The next one is the weekly plan and scenarios. And so this is what I would use when it's starting to get a bit tight and you just need to survive for a few months before a fundraise. Ideally, this never happens. In an ideal world, this doesn't happen. But for the clients I have been working with, usually it's because something drastic has happened. So for example, a lead investor pulled out and we're going back to the drawing board for a fundraise. We had 9 months runway. We now only have 5 months runway, and it's we need to keep a close eye on it. Or a big partnership that we're relying on to get the business to break even has just pulled out. We need to go back to the drawing board. So it's these kind of things that happen very commonly in the startup world. And so you need to make sure that you keep a good eye on what's happening. So this is when we do scenario testing as well. So I have the closing balance of the baseline at the top, just because while I'm tinkering around in here, I want to know what's happening. And I would use the budget as a starting point. So actually, I would use the cash flow actuals as a starting point, and then I would go back and forwards between the budget. So this is looking as a week by week basis. I just have the week commencing here in the template that you can download. Again, the link will be below. You can do week closing, doesn't matter. But essentially, I'm looking at all of the cash that's coming in. So this is, I would think about it from a conservative and a realistic point of view. So for example, in your budget, you may have invoices coming in every 30 to 45 days. You may find that actually it's closer to 45 to 60 days. And so I would put that in here. I would also put in the revenue levels that you're very comfortable with, that pretty much 100% you're going to do. We'll deal with anything that is over and above what you're currently doing down below. So this is where I put on all the incoming. I have a line in here for credit and debit cards, largely because not many businesses use expenses anymore, and instead they're using debit and credit cards with their team, and these would come out obviously either monthly or daily. A lot of startups can't get a credit card. I mean, maybe they can get Amex, but that's it. So you have the team using debit cards. So I would look at the average of what comes out on a monthly basis, on a weekly basis, and just put that here, just so you've got that covered. Any cost of sales or key suppliers that you need to make sure happen all the time, I would put them in as well. And then you've got the most important payment. So this is the one, well, this one, and anything that's similar to that are the ones that sometimes I would put this in first when I'm looking at it, because these are the ones that you cannot forget or cannot miss, essentially. So some of the, these ones, but, or these ones, you could potentially renegotiate, delay, ask for a payment plan, what have you, but these ones you can't. And obviously, employees are the most important part of a business, so you have to keep them happy. So, this is why this is quite useful, is because in this, it may say that, particularly when you're getting really close, it might say that you have £10,000 by month end. But what might happen is, a large payment may come in on the 30th of the month, and that will show you that you are in the black, but actually you wouldn't have been able to pay wages in time because you were in the net, you were close to zero beforehand, and wages is obviously quite a large bill. So this is why the weekly is quite useful, is because it's moving things around to make sure that you are going to hit your wages bill, which is usually close to the end of the month, usually around the 25th, or fortnightly. And so you need to make sure that you keep a really close eye on managing that. Then you have your taxes. and your contractors, I mean, contractors, also particularly your tech contractors, I mean, finance contractors might be people like myself who are doing this, but your tech contractors, they may revolt or stop working if you don't pay them in a timely fashion. Professional fees, sometimes you can negotiate these. VAT and sales tax, similarly, you can talk to your tax department and explain to them that you're awaiting a fundraise. You may need to delay it. These ones, these ones often come out automatically, particularly these two, they might come out automatically. And you may find that you can either switch them on or switch them off. So these are the ones that you can play around with, but they will come out automatically. So you have to have that conversation both with the founder and your head of marketing. And then you can't forget your other direct debits, so and things like rent and what have you. So with the planning, because direct debits, they're set up automatically, they're deducted straight away from your bank account, you can't forget them. And this is why I've highlighted them as a separate line item, because sometimes when you're looking at things, it looks okay, but you forgot about a direct debit that's coming out, and then it's all disarray. So this is what we use. Obviously, we add things or subtract things depending on the client. So you can do that too if you download this template and make a copy and save it on you can add it to whatever suits you. So then that gives you a closing balance, and it's reflected up here as well. And hopefully it's in the black for the whole time. But there'll be times where it's not red, and that's when you start moving things around. Now, what I have underneath is scenarios. So these are things that you may have in your budget that may or may not come to fruition. So things like a better conversion rate, a new partnership, some tax credits, cutting certain costs, or, adding things or subtracting things. And this is where you can put these in and see how that would affect an adjusted balance sheet, a cash flow. And then there's another scenario. So another, you can look at, okay, if we do this, this, and this, what will happen to our cash balance? Or another idea is we could do this, this, and this is what would happen to our cash balance. So this is how I would have that conversation with the founder. It's like, today's business is going to give us this. This is the future. So we need to make sure that either this and this absolutely happens, or this and this absolutely happens within a given time frame. So this is where I would spend time with the founder, sometimes the leadership team, but founder or co-founders, working through what needs to be done beforehand. Now, just a word on negatives, particularly when you're thinking about this, it's all great to have a fundraise number because you're expecting to close at the end of May, and say we put in, the fundraise amount in here, and it's like, oh, everything looks black. I would absolutely be super conservative on this, because I can tell you right now, if you close at the end of February, you might start getting some drip feeds, but it might take 2 months for this number to get in. So I would always allow 8 weeks of the amounts to come in. Obviously, closer to the date, you'll probably get a better idea. But I think when you're a few months out, I would push this way back and say, what can we do to make sure that we hit our payroll numbers for those 2 months after a close? And it probably will be a negotiation. It is much easier to negotiate with someone a couple of months out than it is 24 hours before. So I would highly recommend doing that as you're looking at how to manage the payments that are coming out. And so this is exactly what I do with my clients today, as I said, and I will give a link to this template that you can take a copy of, and hopefully this will help you with your cash management. So that's everything for today. Obviously, it's not something you have to do on a every single month. You can if you want, particularly if you work for a startup where there are real peaks and troughs and you have to deal with seasonality, you have to deal with large payments irregularly, then something like this might be quite useful. But I find it to be very useful just before a fundraise, and again when things start getting a bit tight. So hopefully you found that useful. If you haven't already, please subscribe to this channel. I do post weekly on how to manage finances for a startup and scale up. And also, if you want to move into a leadership role, or you're in a leadership role for a startup, you haven't worked for a startup before, or it's your first leadership role, then this is the channel for you. So click subscribe and I will see you next week. Cheers.